Welcome to this installment of our Industry Leadership Series. I'm Brian Dobson, Head of SPAC and Disruptive Technology Equity Research at Chardan Capital Markets. As always, I'll start the call on an interesting note with some important disclosures. So during this call, we will not be discussing Chardan research. Any discussions about research should be coordinated between a participant and their respective salesperson. Our compliance team has asked me to read this statement for the investor call. By participating in this call, our speakers attest that they have made Chardan aware of any potential conflicts, and they will not discuss any material, non-public, or confidential information that they are aware of that may breach their legal, regulatory, or fiduciary responsibility to any parties. So with the disclosures out of the way, it's my pleasure to introduce Fred Thiel, CEO and Chairman of the Board of Directors at Marathon Digital Holdings. We launched coverage of Marathon last month, and our research is available upon request. Fred, thank you so much for joining us this morning.
Great to be here.
It's great to be here with you as well. So let's get into, I guess, a big picture question. Let's delve into some of the recent events pressing the industry. So as you take survey of the global landscape, what do you identify as the global trends that will shape the Bitcoin mining sector over the next few years? And I suppose further on that, how have you positioned on to prosper in that type of environment?
Well, I think one of the key things you have to think about with Bitcoin mining is we're driven by kind of the macroeconomic environment because that drives the price of Bitcoin. And the price of Bitcoin right now is in its winter period. Some people might say that's due to the cyclicality. It's in its traditional winter. I think this is more driven by really the macro environment. We went through a major de-risking of assets earlier this year that's impacted both equities, but also any kind of risk on asset. And crypto certainly is one of those. And Bitcoin being the kind of biggest of the cryptos was also affected by that. We also see the dollar coming up in value. The dollar and euro today hit parity. That's something that hasn't happened in 20 years. And asset allocators are looking, where do they put their money? And Bitcoin is viewed by some as a store of value. And so obviously you're looking at what's happening with Bitcoin, what's happening with the dollar. If the dollar continues to strengthen, well, you'll keep your money in fiat, effectively your assets in fiat and fiat denominated assets for the time being. So I think until the Fed and the macro environment kind of eases somewhat and risk on becomes a little bit more palatable, I think we're going to see Bitcoin trading in kind of this choppy area, kind of between $18,000 and $22,000. Things that could change that, obviously, Fed easing off on interest rate hikes. There is a point where the Fed can't raise interest rates higher. Where all of a sudden it becomes that they can't even pay the interest on their debt. So I think, we're likely, based on the inflation print we saw today, we'll see, another aggressive rise in another rate increase, most probably, 75 basis points, possibly 100 basis points. But we're coming to a point where they can't raise anymore. I think the Fed's being driven by a couple of things. And again, I'm not giving financial advice. This is just my opinion. But I think that the Fed is being driven really by, they need to get interest rates up so they can cut interest rates when we get into the recession and they can stimulate the economy. It's really hard to cut rates when rates are 1.75, whatever they are currently. So I think that's kind of weighing on kind of Bitcoin. Energy costs are also impacting Bitcoin. There are some miners whose energy pricing coming off the grid, especially in Texas, where there's heat wave has been going on. That's impacting them in two ways. Spot market pricing for energy is very high, and the amount of curtailment being done, meaning shutting down mining rigs because the grid needs the energy, is also running high. And if you look within the Texas grid, one of the challenges with this high amount of heat is a lot of the renewable energy sources, being wind in Texas, aren't operating as efficiently because of the heat. And so they're relying more on traditional base load, which is nuclear, coal, natural gas, which drives the energy prices up. So I think Bitcoin miners are kind of getting pressured by both energy costs and the low value of Bitcoin. You've seen Bitcoin miners selling Bitcoin. Marathon hasn't sold any Bitcoin yet, and we are, I think, have over 10,000 Bitcoin on our balance sheet today and continue to add to that. That's more due to the differentiated model that we operate, where we're very asset light. We don't have these big infrastructure assets that other miners own that they have to continue to fund, hundreds of employees, operations, and things like that. So it gives our model some differentiation there. But I think longer term or midterm, we'll see Bitcoin start moving back up as the kind of risk-on environment becomes a little bit more palatable. When the Fed kind of stops hiking, likely Bitcoin will be one of the first movers up. Equities will still have a drag because of earnings due to the recession. So we're mildly bullish on Bitcoin's kind of midterm increases. And again, cyclically, as we go into a halving event, which happens in kind of spring of 2024, there's traditionally kind of an uptick in the value of Bitcoin. So we're bullish from that perspective as well. I think outside of that, the capital markets are also affecting Bitcoin miners. And the last year was very easy to raise capital. So miners were able to invest in more infrastructure. They were able to place large orders with the mining rig providers. Mining rigs were at all-time high prices. And now in the kind of depths of winter, there's a lack of capital. It's very hard for certain miners to raise capital. There were miners who took on a lot of debt last year and the year before to finance mining rigs at kind of double-digit interest rates. And they're having some challenges servicing those. Miners who put deposits on mining rigs with the large hardware manufacturers are sitting in situations where they maybe can't complete those payments, the balance of payments that they have to do, because they haven't been able to raise money and didn't have cash on the balance sheet. I think in our particular case, we have the benefit that our orders, our large orders with Bitmain have a price protection mechanism in them, whereby the price is adjusted just before delivery, and so we're seeing some benefit of that, as we announced recently, which means that we have to use less capex to acquire the balance of those miners. So I think you're seeing some miners who are under just liquidity pressure. I think you're going to see some consolidation in the space, smaller miners consolidating with the bigger miners, or smaller miners consolidating together. We're going to see more capacity, which has been a constraint, become available as miners who have built this capacity now can't afford to put machines of their own into the shelves, so to say. We're getting a lot of calls, certainly from people saying, hey, do you need capacity? And not being an owner of infrastructure, we're sitting a little bit in the catbird seat, I guess you could say, in that we have a lot of miners and that are going to be coming in the back half of this year, and we are obviously very open to talking to people about where we could host those. So I think generally speaking, miners are going to be under kind of pressure, but I think that's going to ease as Bitcoin price starts moving up and as we get into cooler season when mining rigs can operate more effectively. But the benefit is that the global hash rate, which drives kind of the productivity of our miners, is not going to be as large as it was originally forecasted to be. Last year, BitUda was forecasting the global hash rate to be 360, 375 at the end of this year, up from 190 at the end of last year. Now the forecasts are 250 to 275. So that lower global hash rate means that there are fewer miners competing for a fixed number of Bitcoin, because Bitcoin's a zero-sum game. There are 900 Bitcoin awarded per day, at least up until the halving, when it'll drop to 450. And so the fewer mining rigs that are operating means the higher the number of Bitcoin that each respective miner can get. So, I think it's generally good for the industry. I think the other thing that's really this shows is how smart the Bitcoin network really is. So you think about it, as times are good, margins are fat, people invest, the difficulty rate goes up, productivity on a per mining rig basis goes down, and then as the business gets tighter, margins get thinner, people start turning off miners, the productivity goes back and increases. So it's this very interesting sort of ecosystem, if you would, that continually is self-balancing. It's a brilliant concept when you think about it. There are not many economic models that operate that way. So it was a long answer to your question, but I think there were a lot of points that I had to get in there.
That was a great, very fulsome answer. Definitely looking forward to delving into that ecosystem, as you put it. I guess just to touch on a couple of the things that you mentioned. When it comes to energy curtailment, do you expect to see more of that, and for those curtailments to last longer, particularly in areas with, call it, a heavier reliance on green energy over the summer? Or, I guess what are you seeing in that environment?
Yeah, so let me unpack that question because there are a lot of aspects to it. So just generally speaking, if you look at the energy markets, and I'll use Texas and ERCOT as an example, it's an unregulated energy market. And essentially, the Bitcoin miners in Texas have a very good relationship with ERCOT, whereby when the grid needs more energy, such as right now with the heat wave going on in Texas, Bitcoin miners have curtailed a gigawatt of power, which is a considerable amount of power on the scale of things, and essentially giving back that power to the grid so they can give it to consumers. The funny thing about energy is that most people think that we use a constant amount of energy, and it's not true actually. Most energy load on the grid is between 4 p.m. and 9 p.m. Why is that? Well, consumers come home, they turn on their air conditioners, they cook food, they wash their clothes, they're watching TV, etc. Commercial load, if you would, is kind of constant during the day, but it starts tapering off at 4 p.m. And so if you think about how the energy grid operates, you have what's called base load, which is the type of energy you can't turn on and off easily. And that's basically nuclear at the bottom, which, once it's on, you can't really dial it up or dial it down very easily. It's very complicated to do that. And so that runs in the base, and that's the bottom energy. Then above that comes coal, and coal has some similarities to nuclear in that it's very hard to dial up and down a coal plant. It takes days to adjust its energy generation. And most coal plants to operate efficiently have to operate at a fairly high capacity. And so there's not a lot of room for excess. So what then happens is natural gas plays this kind of role of a buffer. And it can do so 24/7 when needed, such as now during the heat wave, or in cooler periods, or during the night and during the mornings, it may not be needed, and therefore they can dial it back. And these are called peaker or shaver plants, where it's essentially like a big jet engine that you can turn on in a few hours. You can run it, and then you can turn it off fairly easily. And so it's adjustable in its load that it can provide. And then comes renewable. So there's this concept called, and let me just, on the renewable, in Texas, for example, it's predominantly wind energy. Wind blows in the afternoons and evenings, which is when that energy is most needed. But if the energy isn't needed, it's the first energy to be curtailed. And so if you think about that stack of energy types I mentioned, nuclear, coal, natural gas, and then comes renewable, well, when you don't need energy, you work from the top down and shut things off. So you shut off the renewable, then you shut off natural gas, then you can't shut off the coal and nuclear really. Because at the end of the day, everybody expects electrons to come out of the plug whenever you plug something in. So that renewable energy gets shut down first. And so from a curtailment perspective, that means the grid needs energy. So it's going to draw on that renewable if it's available. And so in the case of Texas, if the wind is blowing, you have that wind energy. But right now with the high heat wave, the wind has decreased, so you don't have that much to draw on. And so for that reason, there's even more of a need for curtailment. But if you didn't have these Bitcoin miners consuming energy predominantly, a good mix of renewable together with the grid energy, then you wouldn't have this buffer that could be given back to the grid when it needed. So Bitcoin miners fill a kind of role as a type of capacitor for the energy grid. More importantly, if you locate your miners behind the meter at the point of power generation at a renewable plant, which is predominantly our strategy, where you essentially, so we are siting our miners at a large wind farm in West Texas. This wind farm gives us energy whenever it's running, and then otherwise we take energy off the grid. By us providing that wind farm with a base load consumption, we provide them the revenues and therefore the profitability so they can afford to operate that plant more efficiently, lowering the general cost to produce electricity. But more importantly, it gives them an incentive to add more capacity. One of the challenges, however, in the electrical industry, the electrical transmission industry, is the grid has congestion points. Think of it as plumbing. And if you have a lot of electricity in one part of Texas and you have a lot of demand in another part of Texas, you have to ship it through the grid from its point of generation to its point of consumption. And if the grid doesn't have the bandwidth, in other words, if the pipes aren't big enough, then you can't transport more electricity than the pipes can have capacity for. And so what ends up happening is you get grid congestion, which is it doesn't matter how much power you could generate in West Texas, you can't get it to East Texas because the grid can only transport so much. So that's another place where Bitcoin miners play a very important role for the grid, is that we can consume power at the point of power generation when it can't be shipped onto the grid. So we provide the generator another way of being profitable in that it's electricity that otherwise would be wasted. And it's amazing the amount of electricity that is wasted due to grid congestion and curtailment. You know, few people realize, but upwards of 8 to 10% of the power that's generated in the US is wasted just due to heat, meaning it loses its energy as it's transported over the grid due to impedance or resistance, which generates heat. That is a huge amount of energy, more energy than all the Bitcoin miners in the world consume alone. And in the US, by way of example, we generate and consume about 4 terawatts per hour. And 8 to 10% of that is hundreds of gigawatts, which is more than all the Bitcoin miners in the world consume. So there's a lot of energy waste. So Bitcoin miners play that role of load balancing, if you would. But for the grid, especially now, renewable can act as a bit of a supplement. But if the wind doesn't blow, then the renewable is not really generating. And so you get this double whammy. It's kind of like in the winter storm that hit Texas a few years back, it was so cold that the natural gas pipeline valves froze. And so you couldn't get the natural gas to the gas plants to generate the electricity. So when the infrastructure is impacted by the climate, it's kind of a double whammy. But I think Texas is doing really well right now. It seems that by Bitcoin miners shutting down, that extra gigawatt of power is certainly helping balance things out. And it'll be very interesting to see in a few weeks when people look back and say, how did the grid do? And were Bitcoin miners responsive and collaborative with the grid operators? I think it'll be a positive story.
Yeah, that's excellent. So I guess as you're thinking about that evolving shape of energy and grid infrastructure, how do you describe the industry competitive landscape right now, and how do you see that competitive landscape maturing and evolving over the course of the next year?
So I think in the energy world, you've got this challenge that we want to build lots of renewable energy. We don't want to build more fossil fuel energy. There are things like methane gas capture for power generation, which work well at small scale, that you can't do that at large scale. And so you need to build out more renewable energy. And the challenge with renewable energy is it's not available 24/7. So you need to have battery capacity and technology to store the energy so that you can make it more available. Or you just have to overbuild so much energy, renewable energy, that it becomes financially unviable. So I think the whole energy sector is going to go through kind of a rethinking where you're going to see wind farms with solar combined so that you get more coverage, because the sun shines 9 a.m. to it's kind of 3 p.m. from a solar energy generation perspective. And then the wind works in the afternoons and evenings. So you get almost 60, 70% coverage that way. But that will require the grid congestion issue to get solved, because now you're generating a lot more energy in places that don't have consumers that you need to get it. So then you start looking at things like hydrogen. And do you build out excess renewable energy capacity such that you can electrolyze hydrogen out of water. You split hydrogen and oxygen molecules, and then burn that hydrogen, which is clean, when the wind or sun isn't shining or blowing, so that you have 24/7 coverage. So that's a technology that still has to become economically feasible at scale, just like batteries have to become economically feasible at scale. So when you look at the competitive environment within the Bitcoin mining industry, it really comes down to being very agile. How do you operate such that you're able to site your miners at locations where you have this low cost of energy and you have high availability, such that you can operate very productively at low cost, even when we're in a kind of winter for Bitcoin and crypto. And I think the Bitcoin miners that invest heavily in owning their infrastructure, they don't have the ability to pick up their systems and move. And I think competitively, that's a big differentiation in our model versus most others, in that we can decide where we want to site our miners based on economic incentives and business reasons. We're not thinking about 20-year projects of owning infrastructure. And these Bitcoin mining data centers are a bit unique in that, unlike a traditional data center, which is a 20-year kind of life investment, in the world of Bitcoin, the technology is advancing so quickly that, for example, you build a container field where you house these Bitcoin miners in effectively what are cargo containers, modified cargo containers, with great airflow through them. And then lo and behold, this technology called immersion comes along, where now all of a sudden you want to put Bitcoin miners in this non-conductive fluid, or dielectric fluid as it's called, whereby you can keep them cool and run them even when it's very hot out. And so all of a sudden you need to rip and replace all this infrastructure you just invested in. And so these Bitcoin mining operations, every 5 years or so, you're having to do major upgrades to them. And you have whole new machines, they have new form factors, they're more energy efficient. And so we're all driven to continually upgrade our systems. Well, it's a very different model than traditional data centers, where you invest for 20 years and it's a great investment that has a good return. Well, Bitcoin mining infrastructure, you really have to look at it as about 70 to 80% of that infrastructure has a 5-year life. The containers have to be replaced every 5 years, most probably, as the technology changes. If you have a building, the building doesn't have to change, but what's inside the building has to change as you move maybe to immersion. So I think we're seeing a period where owning infrastructure isn't maybe the best way of getting a return on your assets. And I think you're going to see a lot of the bigger miners, the kind of Riots and Cores, look at their business and say, where they may bifurcate essentially their infrastructure business from their actual self-mining business, and essentially spin out the infrastructure part of their business as a traditional data center business and finance it that way, and then run their self-mining business kind of as a separate entity that leverages the infrastructure business, but is a separate business, much more like our model at that point.
Yeah, the asset light aspect to your business model is very compelling, and that's a very interesting kind of forecast for, I guess, a consolidation of business models across the sector. So at this point, I'd like to remind investors listening to the call that you can drop a question in the Q&A or email it to me directly. We can open up the call for participant questions at the end. So switching gears a little bit, let's talk about the global hash rate. So given the lower Bitcoin price, how do you believe the hash rate will react? And if you expect a decline, how low could it go?
So if you look at the global fleet of mining rigs, the actual computers, if you would, that are installed, most people think there are tens of millions of these things. There are actually fewer than 4 million of them installed globally. And of that fleet, roughly 20-ish% are old generation miners. So the equivalent of S9s or S17s, which are Bitmain machines. The S9 is 6-7 years old at this point. It's 4 to 5 times less energy efficient than the current S19 generation. And so those miners are reaching a point at a Bitcoin price of kind of 18, 19,000, where with the global hash rate at around 200 exahash, where we are today, 200 to 220, they're borderline profitable. And so you're starting to see people shut those down. Now, while they make up a, good portion of the fleet overall, from a perspective of how much hash rate they actually generate, it's 5 to 7% of the global hash rate. So as those machines come off, you'll see that hash rate number drop, the global hash rate number drop 5 to 7%. We're already seeing the difficulty rate, which is kind of the measure of that, decrease a couple of percentage points at each adjustment period more recently. That being said, miners like Marathon are in the process of expanding their capacity. We're growing by nearly 6 times over the next 12 months. So we're growing 6-fold over 12 months. So we're adding, nearly 20 exahash additional capacity to what we currently have. Well, so number has to go up then to compensate. So, and there are other miners who are growing as well. So I think what you're going to see is less of a decrease and more of a slower increase. And so, as I said earlier, while last year Biduta was forecasting in the high 300s and is now forecasting in the high 200s, I think at the low end, we'll see maybe exiting this year at a hash rate of around 250, and at the high end, maybe 275, 280, which is still, it's 30-40% growth year over year over last year, but less than the 80% growth that was initially forecasted. So I think, that'll bode well for the miners that have rigs operating and can produce Bitcoin.
So do you think that, call it well-positioned, well-financed miners such as yourself, they'll continue to grow hash, whereas you'll see some of the smaller players that are, running into some obstacles, perhaps curtail, and that's where the shifts are going to be? Or do you expect, curtailment from some larger players as well?
Well, I think some larger players have already announced decreases in their buildouts. Core announced that their expected hash rate at the end of the year would not be as large as they had initially forecasted. I don't know what Riot has announced recently in that regard, but I think generally speaking, the larger miners are going to continue along with their plans of expansion, and where you'll see the slowdown in growth will be in the smaller miners who just can't pay for the miners they need to grow. They may have the capacity, meaning infrastructure, they just can't pay for the miners to grow. They put money on their initial deposits. They aren't able necessarily to make the second deposit payment or the final payment. And so I think that's where you're going to see the decrease. What does that mean? Greater consolidation of hash rate amongst the large miners. But I think you're also going to start seeing more mining outside of the U.S. starting to grow, because energy prices in the U.S. and just the ability, the capacity to grow in the U.S. is getting tighter from a available electricity perspective. I think there are new regions in Latin America, for example, where you're going to see growth. I think there will be growth in hash rate in Russia. Mostly because there's a ton of idle nuclear assets in Russia. There's a lot of cheap nuclear energy. And I think, Russia is going to view crypto as a tool to use to essentially be able to, fund some trade, not from a perspective of sanction busting so much as just it's a different currency you can use. If you can't pay for things in dollars and nobody wants to receive rubles, then you have to acquire that foreign currency. Well, if you can mine Bitcoin, then you can use that to pay for things. So I think you're going to see Russia as a percentage of the global hash rate grow. China there's still a lot of mining going on in China, regardless of the ban. It's happening kind of under the radar screen. So you may see some more expansion there, though I don't think that'll be large in scale. But I think you'll see expansion in Latin America. And, there's some opportunities in Africa that I think aren't necessarily executable in the short term. But, for example, Kenya has, 17 gigawatts of geothermal power that they don't really have a lot of consumption for. And so that's a place I know a lot of people are starting to look at to see, how could you do it? The Middle East is looking to expand, United Arab Emirates, Saudi Arabia, countries like that have the ability to generate huge amounts of solar energy are looking at Bitcoin mining as a way to help fund not just that expansion, but also the combination of Bitcoin mining with electrolyzing hydrogen. I know Saudi Arabia Saudi Aramco is considering becoming the largest manufacturer or producer of hydrogen in the world. And to do that, they need to electrolyze it, and putting some Bitcoin mining on all that solar power would be a great way to help finance that. So I think you're going to see those markets start expanding as well, and so that'll drive expansion in 2023 if the market in the U.S. remains constrained, and into 2024.
Those are all pretty exciting markets for mining moving forward over the next couple of years. I guess just going back to Russia, if the country were to take the path that you laid out, do you think that might drive further international trade adoption for Bitcoin?
Well, I think if you go back to what was in the news, 6-9 months ago, Saudi Arabia said, we maybe should be thinking about moving off of the petrodollar and moving to a basket of currencies. And one of the currencies included in that basket was Bitcoin. The benefit to Bitcoin over a sovereign currency or fiat currency like the ruble, the dollar, the pound, the euro, Swiss franc, et cetera, is that it's not controlled by any one government. And so, imagine you're a commodity producer, whether it's oil, natural gas, nickel, coal, whatever it might be, and you're selling your commodity in dollars. Now the U.S. has weaponized the dollar, so okay, I don't want to hold my foreign reserves in dollars. Maybe let me hold them in something else. Well, there aren't many global currencies that have the scale and liquidity of the U.S. dollar out there. You certainly couldn't do it in Swiss francs. Saudi Arabia couldn't price oil in Swiss francs and keep all their money in Swiss francs. The euro has a lot of volatility to it. And, the euro has issues where, the European governments may decide to devalue the euro. Look at what's happening vis-a-vis the dollar right now. In Europe, because of the tight economic environment, they have not raised interest rates at the same tact as the US, and so therefore the euro is falling behind the dollar and decreasing in value. Well, imagine if you were holding your assets in euros right now instead of dollars, you wouldn't be a very happy person. But, obviously there's a lot of volatility in Bitcoin today, so that may not be the ideal place to hold your assets. If you're looking for long-term holdings, I think it does, but, in the short term, it's certainly been very volatile. So if you price your commodity in Bitcoin, however, you can always convert it to another asset once you've received that Bitcoin. You could convert it to gold if you think that's better. You could convert it to dollars, pounds, Swiss francs, yen, whatever you want to do. But what's happening in the markets today internationally is almost every currency other than the dollar is losing value, and that's driven by the Fed's policy of raising interest rates. There's this, people are getting good yield on their dollar-denominated assets. And so once the Fed kind of takes the foot off the brake and on interest rates, or rather, applies the brake to interest rates, then you may see a weakening of the dollar, and at that point, all of a sudden, people are going to be looking to where to put their money. And Bitcoin may very well be a benefactor of that. But I think I would expect to see a certain number of commodity-producing nations start pricing their commodities in a basket of currencies, and one of which will definitely be Bitcoin. And you may see Russia start doing that. You may see Saudi Arabia start doing that. The oil producers, certainly some African countries will do that as well, I think.
So you mentioned some price protections that you have on contracts and general price. What's your outlook? Can you maybe give us a little bit more color on how those price protections work?
Well, essentially, the way a miner procures miners is there are 3 payments. You put a deposit down at the time of order, which is somewhere between 30 and 40%. 6 months before receiving the miners, you pay your second deposit, which is somewhere between 30 and 40%. And then the last payment is the balance of what's owed. If you have an agreement to purchase the miners that is based on a price protection mechanism, like some of our agreements, then that last payment is kind of trued up based on kind of where the price of Bitcoin is and what the market price for the mining rigs is. And mining rig pricing follows Bitcoin fairly closely. So if you placed an order at the peak in November and you're now receiving those miners, where we are today, then Bitcoin has dropped by 60, 70%. Mining rig prices have dropped not as much, but you've seen anywhere from 20 to 35% depending on the model of miner that's dropped, and so the pricing is adjusted accordingly. Now, mining manufacturers also sell miners based on fixed price agreements, and if you bought miners based on a fixed price agreement at the peak, then that's not a good thing because you don't have that price protection mechanism, and some people may have done that. So, but that's essentially how it works. So, if you do have that sort of price protection mechanism, then, in an ideal world, that last payment you make, basically you don't have to make it because you've already paid for everything through the deposits that you made.
And I suppose with, call it Bitcoin hovering below $20,000 right now, what are your thoughts on hodling coins, and have your views changed at all, or is that still the, call it a core strategy?
So we are long-term bullish on Bitcoin. And I think generally speaking, most Bitcoin miners are long-term bullish on Bitcoin, or they wouldn't be in the business. Certainly you wouldn't be investing the amount of CapEx that you invest in this industry if you weren't long-term bullish on Bitcoin. So what really drives miners hodling or decision is more a liquidity need issue. And so you can see, Core sold 75% of their Bitcoin holdings because they needed to pay down debt, restructure debt. Riot has sold Bitcoin to fund operations and CapEx requirements. So I think the miners that have liquidity needs clearly are having to sell their Bitcoin because it's an asset they hold. And you can look at just the price points where these miners have sold. They didn't sell it at 50,000, they didn't sell it at 40,000, they didn't sell it at 30,000. They started selling it around 20,000. Again, we're bullish. Our liquidity is still very strong, so we haven't had a need to sell Bitcoin. That being said, would we sell Bitcoin if we had to? Of course, that's just prudent business operations. But long term, we're bullish on Bitcoin, and therefore, our inclination is to hold our Bitcoin. And we have borrowing facilities where we can collateralize our Bitcoin if we want to, and we've been making sure that we don't have significant amounts out on any of those lines. And generally speaking, Marathon has very little debt. We have a convertible note out there which matures in 4 years. But other than that, we just have a small amount out on a revolver. So we're very good in that regard.
Excellent. And before we open the call for Q&A from our audience, let's talk a little bit about consolidation, M&A in the industry. I guess, what are your thoughts there? Do you think that this is an opportunity for larger players to consolidate, or perhaps you could expand on your idea that business models will become more streamlined as companies break themselves apart?
Yeah, I think consolidation is driven by a couple of things. You would want to acquire another miner because either it gives you access to very low-cost mining rigs and or hosting capacity, because somebody has built out hosting capacity and they have mining rigs running and they're operating at a very low energy cost maybe. So then you have to look at for how long are those energy contracts priced in, or the hosting priced in? What is the age of the mining rigs? What's the economic life left on them? As we come into the halving event in 2024, unless Bitcoin doubles in price, the profitability is going to decrease even further from where it is today. And so you need to have the most energy efficient miners. So if somebody has older generation miners, would you really want to acquire those knowing that within less than 2 years we're in a halving event? And so you have to kind of look at what's the economic life left on the miners you would be acquiring, what are the value of the energy contracts they have, the hosting sites that they have, and kind of do your calculus. Is it better to go acquire new miners that are more energy efficient, contract new sites or build new sites, or is it better to acquire? And, no different than in any other industry. The difference is, we have this halving event, which is driving a kind of time value part of the equation. So kind of like an option agreement, option contracts, you have the intrinsic value and then you have the time value. Well, the time value is now less than 2 years. And so you have to, if you're going to do something, you want it to pay back in a short period of time. So for highly distressed assets, I think there'll be good opportunities for consolidation. I think it gets a little more difficult the bigger the miner is that wants to be acquired, the harder that deal is going to be to get done, because it's typically going to be more complex, and you come into the time value of the investment. So I think you're going to see a lot of consolidation amongst the smaller miners by either the big ones or smaller miners just merging together. But I think it's going to be much harder for two large miners to come together. If Core and Riot were to go together, I mean, they have similar business models. They operate, self-mining and hosting operations. They have large infrastructure. Could they do it? Yes, possibly, but the question is, would 1 + 1 = 3 there? No, best case, it would equal 2. So then you're going to reap some synergies of SG&A and things like that, but otherwise not a lot. So, would it make sense for a Marathon to acquire one of those big miners or to merge with one of them? Well, we provide the benefit to a large, a miner that has lots of hosting capacity available, that we have a lot of miners available. So there's some synergies there. But outside of that, I don't think any of those larger mergers necessarily pencil at this point. And we'll see. We'll kind of see, how the market develops, where valuations are, and what happens with the price of Bitcoin. Worst case scenario is nothing happens with any. There's no acquisitions because it just doesn't make sense. People don't have, they're the publicly traded miners. Their equity isn't worth enough to do a deal. It would be too dilutive or whatever it might be. But I think you're going to see some consolidation, definitely, and most probably towards the back half of this year.
So I would imagine that any deal of note crosses your desk. Are you seeing a lot of distressed assets, or is that something that might be yet to come if prices remain at these levels?
I think people are feeling some pain, and it's causing them to dial back growth. I don't think we're quite at the point where you're seeing, any miners of note starting to sell off assets. You have just in the marketplace today, you have things like, everybody's familiar with the company Celsius. Some people may not know, but Celsius has a mining operation actually. And that business, is likely going to become a distressed asset that'll be for sale. And you have other miners who just have too much debt, and they have borrowed money from people like Galaxy and NYDIG and others to finance their miners' purchases, and now they're defaulting on those payments, and NYDIG and Galaxy and those are essentially foreclosing on those mining rigs, and they don't want to be in the mining business, so they're likely going to sell those rigs and the hosting agreements for where they are hosted. And so you're going to see some of those opportunities come to market. And so it's kind of the, they don't want to be in the loan to own business, but, miners may look at buying essentially foreclosed miners, which is a lot less expensive than buying a whole mining company, right? So you also have to look at the risk. Asset purchases of foreclosed miners could be a very attractive way of consolidation. That's kind of not the traditional model.
Excellent. So now I'll open it up for a few questions we've received from the audience. The first wants to tap your insights on the energy market. So I guess, what's your outlook for energy prices over the next 24 months?
So I think, generally speaking, if you look at energy futures, which are kind of, future markets or predictive markets, 2 years out, the expectation is we'll see energy prices substantially lower than where they are today. I think there's a fair amount of argument that can be made for, there's more demand than there is supply for energy. And we had a few years of artificially low pricing on energy because producers had just overproduced. And then they scaled back. Well, now everybody is busy scaling up. The question is, are they going to scale up so much that we're back where we were before, or are they going to be more prudent and not scale up to that extent? You got to realize that energy markets are self-balancing. So if energy prices get too high, then people start shifting the type of energy they're using. And so, if oil prices start getting too high, then people start moving to things like natural gas and other sources for energy. You could even get to a point where there's an incentive to start building more nuclear, and not nuclear in the sense of traditional large central utility nuclear power plants like 3 Mile Island or Fukushima, but what are called small modular reactors, SMRs, which are essentially mass-produced assembly line, miners that, not miners, nuclear facilities that are kind of 100 megawatt capacity, that don't require all the liquid cooling, that are much safer, that operate more like the nuclear systems you see on US Navy vessels, which are very safe. They're small, they're easy to maintain, easy to manage, they run for years, they don't generate a lot of nuclear waste. And then you have fusion energy, which is still 5 to 10 years out at the earliest. But I think SMRs will be a form of energy that you'll start seeing being deployed. I think the first one is scheduled to go live within the next 5 or 6 years in Wyoming, and then you'll see kind of those come on. But 2 years out, I think everybody's expecting energy prices to come back down. Natural gas future pricing, oil future pricing, I think is all expected to come down. You're also going to see a shift in consumption. In the U.S., the expectation is by 2030, electric vehicles will make up a majority of new vehicle sales. And so as that transition happens, there's less gasoline that's needed because more and more of the vehicle fleet starts transitioning to EV. Now that means more electricity will be needed, and that will be predominantly driven through renewable energy expansion. And so I think, the fossil fuel markets longer term will see a decline in price as we move more towards renewable and continue to grow that out. And as our consumption shifts from natural gas and fossil fuels to electricity coming predominantly from renewable sources.
Yes, very exciting things in the energy markets, certainly. Our next question from the audience pertains to your business model. You have an asset-light model right now. What are your thoughts about not owning the capacity to energize miners right away? I guess, how would you compare and contrast those two models right now? And I know that we touched upon that a little bit earlier, but I guess just to follow up on it.
So I think if the person asking the question is asking, is it better to not energize than to energize? It's always better to energize as soon as you can, because if you have the miners, you want to make them productive. If you own the energy asset, the challenge is, it takes anywhere from 1 year to 2 years to build out a facility before you can turn on the miners. And that's if you can get the permits from ERCOT or whatever regulator you're using. Hopefully you're not trying to build mining capacity in New York State, because that's you're likely not going to be able to ever turn those miners on. But there are other states, the Dakotas, for example, Oklahoma and other places like that, where there are great opportunities to build mining facilities. But the challenge is it's a timing issue, right? If I can buy miners today and find places to host them where I don't have to build out the facility, then my time to mining is much shorter. And the asset-light model lets us do that. The only time the asset-light model has a constraint on it is when hosting is constrained. There isn't available hosting capacity. And while that was kind of the market conditions over the past 12 months, we're now starting to see that free up, because people have invested a lot over the last 18 months in new hosting capacity. They're now not able to buy the miners to put them in those hosting facilities. And so we're now seeing readily available hosting sites for people to put miners in. So I think we're going into a period where our model starts making a whole lot of sense. And then over time, we'll have to see. I personally believe that the energy companies are going to come into this space in a big way, especially the renewable energy providers. And certainly, the location we're at in West Texas, which is on a wind farm, that renewable energy operator is very interested in coming into this space. We'll have to see after this winter, how much interest they have in growing that. But I think generally speaking, renewable energy operators are very interested in partnering with miners because it's a great baseload customer for them. So it just makes economic sense. As to whether they become miners themselves, that's a different strategy possibly. But I think what you will see is renewable energy operators looking at data centers as a baseload customer, and a certain portion of that will be Bitcoin mining, a certain portion of it may be high performance on-demand computing. And all of Web 3.0 is kind of driving a shift from these data centers that are, traditional data centers that are on 24/7, 365, where your data and your application are running in parallel together, co-located, to a model in Web 3.0 where the data is residing on the blockchain and your compute power is only used on demand. So I only need to turn on my AI modeling system when I need to generate a new model. It doesn't need to run 24/7, 365. So I'll co-locate that in some facility where I can do on-demand computing, turn it on and off at need. And so I think that's where you're going to see at these renewable sites, these data centers that are focused on Bitcoin mining and high performance on-demand computing. And what that then drives is there'll be lots of capacity in the marketplace, and it won't make economic sense to be vertically integrated as a miner. You'll be better off to use third-party data centers. And for some people of some scale, it makes sense to own your own data centers, but for other people, it doesn't. And there's a reason why Amazon AWS services Netflix and people like that. It doesn't make sense for Netflix to own their own data centers because what they need is a highly distributed system. And the bigger a miner gets, actually, the more important it becomes to have that highly distributed, diversified sites, et cetera. And operating lots of sites yourself becomes, very expensive and, highly capital intensive. And so I think over time, the model will move to asset light, generally speaking, in this industry.
Interesting. That dovetails with our final question from the audience, which is, would you describe the tone of negotiations for new hosting deals? How are those evolving recently? And are you comfortable with your current pace of signings?
So I think conversations are getting easier for the buyer, in which case, this particular case, that's us, because capacity is becoming more and more available, and a hosting provider has built out capacity. They have PPAs, power purchase agreements, where they have to take the energy, and so they want to get the slots filled as quickly as possible. And we can move very quickly because we have miners available to plug into slots. So it's certainly been easier for us in that regard. So I think what you'll see is while we have been very quiet and kind of discussing our hosting agreements, I think you'll see that kind of pace of that likely pick up as capacity opens up.
Excellent. Well, Fred, I always enjoy speaking with you. I learn something new every time. I think that this has been a great use of an hour for our audience. And I really enjoyed hearing your thoughts on the sector and on Marathon. So thank you very much for joining us.
Well, thank you very much for having me. It's always a pleasure, and always open to answering lots of questions. So.
Wonderful.